Hi, and welcome to Homework Rant by Professor Elizabeth Keating. In these various videos, I'm going to be walking through how to solve selected problems from the Introduction to Financial Accounting textbook by Horngren, Sundam, Elliott, and Philbrick. And I'll be drawing from edition number 11, which is also the same as the second custom edition being used at Boston University. Hi, and welcome to the Homework Rant for problem 2-47. In this particular video, we're going to be looking at how to use the expanded financial statement template that includes the income statement accounts. We'll look at how to prepare an income statement. We will also be looking at some important accounting concepts, including the realization concept, the matching concept, many people call that the matching principle, and 3 out of the 4 types of accrual accounting entries. In this example, we're going to be using the expanded financial statement template. Up until now, we had used a basic one, where we had a section on the left for assets, the equal sign, and then a set of columns associated with liabilities and equity. We're going to be adding an additional equity column in the expanded financial statement template, which is for retained earnings, and then we will also be adding columns for revenues and expenses. And what we will see over the course of it is as we record a revenue, as you can see here, a positive $205, it will carry over into the retained earnings column as an addition to retained earnings. In addition, if we record an expense, if we look at the row below the 205, we'll see a negative 155, negative as it's denoted in red and in brackets. You'll see that negative 155 in the expense column also carry over and be depicted in the retained earnings row in the section highlighted in green for the income statement. We will continue to have the closing balance across the bottom as we have had before. Okay, so now we're going to start by looking at a specific example, the Montero Company. It's going to be a wholesaler of furnace as well as air conditioning equipment, and it's beginning business on July 1st, 20x2, which is the point in time that we're at right now. So the opening balance that we're going to have are 0 for every single balance sheet account. Now we're going to look at the first activity, which is that the stockholders are going to contribute $300,000 in cash in exchange for common stock. So we'll see journal entry A as $300,000 increase in cash as an asset and a $300,000 increase in contributed capital affecting an equity account. We'll see this account's called contributed capital. We could have called it paid-in capital or common stock. Any of those would have been fine. You'll also see an acorn, which is denoting that's the start-out contribution, the investment we're starting with that we hope for equity that we hope will grow over time. The asset that we purchased. And now let's look at activity C. On July 1st, the Montero Company acquires warehouse equipment for $100,000. It's going to pay for that equipment by paying $40,000 in cash and also by providing a note payable of $60,000. This is going to be a complex journal entry, meaning that it has more than 2 parts. First, we've purchased an asset that we're putting on our balance sheet, a fixed asset, for $100,000. Second, we're going to have a decline in our assets of $40,000 in cash. So net, our total assets have increased by $60,000. We now need to record the remaining method we're using to pay for that equipment. That remaining method is to provide a note. In other words, we're going to incur or create or accept an obligation in the form of a note payable of $60,000. What should be noted is this transaction is in part an asset swap. We're swapping cash for a fixed asset. When we purchase an asset, whether that be inventory or be fixed assets or even pay a prepaid expense, there is never a gain or a loss on that purchase. So let's think a minute about the fixed asset and what its purpose is on our balance sheet. Its goal is to produce the inventory and services that our company makes we're not actually going to be selling the fixed asset directly for profit. So the fixed asset will be capitalized as it will benefit us into the future. And it is another type of originating entry. We're putting the fixed asset on the balance sheet, and later we'll see how it starts being taken off the balance sheet. And now it's on to Activity D. It's been a busy July 1st, and the Montero Company is also entering into a 2-year insurance policy arrangement to cover fire, casualty, and other risks. The Montero Company is paying out $24,000 and is prepaying for the entire policy. Since it has not yet benefited from that policy, it is considered to be an asset. All the benefits will be accruing to the company in the future. So this is a kind of asset swap. Cash going down, prepaid expenses going up by an equal amount. This kind of accrual journal entry is very similar to the one we did in Activity B to record rent. The reason we're recording this as an asset swap is because we're paying out cash in advance of recognizing that cash payment and the value of it as a cost of doing business. We capitalize the amount we paid out, and it is an originating entry creating an ever larger prepaid expense. Over the next few days, the Montero Company acquires a variety of merchandise, paying in total $35,000 in cash. So cash goes down by $35,000 and inventory goes up by $35,000. Again, this is an asset swap. There's no gain or loss on this purchase. So let's talk a minute about inventory as it differs from fixed assets. Inventory is being capitalized now as it's an asset that will benefit us in the future period, but it will be removed when it is sold. The goal of having this inventory is in order to be making a profit. So in Activity F, the company is going ahead and acquiring more inventory. This time, rather than paying cash, it's doing it on credit. This is also called on account or on open account. So the firm is taking on inventory today and an IOU, a promise to pay later. That's generally called an account payable. It can be called an accrued expense when what you're doing is accepting an obligation, for example, to pay an employee, and that obligation is not documented with an invoice. That's an accrued expense. So both of these types of accounts payable and accrued expense, have a similar feature, which is that we are deferring, waiting, will in the future pay for a cost. So we are going to create an account payable or an accrued expense when we have either recorded a cost, i.e. an expense, or an asset in advance of having paid for that cost or that asset. And so this is an originating kind of difference. And so the account payable is building up from 0 to 190, and later we will see that account drop. So this is the second category of accrual journal entries that we have seen. The first category was associated with prepaid expenses. Finally, the big day has come, and Montero is selling some air conditioning equipment or furnaces. So they have found a customer and a set of customers, and in total the sales that they have had are $205,000. A part of those sales, $30,000, were paid for in cash. The remaining customers agreed to pay later. So let's start first with what's happening on the asset side of the balance sheet. Cash is going up by $30,000, and the remainder, which is $175,000, is being recorded on the balance sheet as an account receivable, meaning that Montero can expect to be paid later by its customers. This is our third type of accrual journal entry. So when an account payable is created, the reason that is happening is because we're going to be going ahead and recognizing that the firm earned some revenue in advance of receiving the cash. What we have just recorded right now is considered to be an originating entry, so accounts receivable is increasing from 0 to 175. We're now going to be moving to the other side of the balance sheet equation, to the equity side. And what we can see we've done is we've recorded a revenue of $205,000. That entry is called the realization principle. The realization principle or concept says that a revenue cannot be recognized until it is delivered or rendered. Montero has been delivering air conditioners and furnaces, and so it is now able to, quote, recognize, unquote, a revenue. So our journal entries right now are an increase in cash and accounts receivable, so assets going up, and that is being offset by a credit or an increase to revenues. So while our journal entry directly increased revenues, revenues is not on the balance sheet. Revenues is actually a subcomponent of retained earnings. So later in the accounting process, when we engage in something called closing, we are going to transfer everything recorded into revenue and expense accounts and transfer them over to retained earnings. So we're going to go ahead and do that in this financial statement template. You can see the tan curved arrow showing that the revenue number is being transferred over and being put into the retained earnings column in a section that I've specially highlighted in green to indicate that those changes in the retained earnings are reflected on the income statement. Now, it actually turns out when you have a sale, there are two components to it. One is the revenue you've recognized, and if you're selling a good, you also have to recognize the cost of the goods that you sold. And so coupled with activity G is activity H. We're going to be matching the revenue that we earn from selling particular products with the cost of those products that we sold. That's called the matching concept. So what you can see here in activity H is the inventory we sold, which cost $155,000, is declining on the asset side. And over in the expense column, you will see $155,000 representing that cost of goods sold, also called cost of sales. Now, expenses, like revenues, are temporary accounts. They're not permanent balance sheet accounts. We create these accounts in order to make it easier for us to create the income statement. So we have placed $155,000 into an expense account called cost of sales. What's going to happen at the end of the time period is we're going to engage in a closing process and transfer that $155,000 in expenses from expenses into retained earnings in where I've highlighted it in the section called the income statement. What you can now see in the retained earnings column is we started with no retained earnings. We earned $205,000 in revenues from activity G. And now in activity H, we are incurring a cost of $155,000. Now we're going to move to activity L. We've now getting to the end of the month. And this is the point in time when we start going back and looking at all the costs that we've recorded as assets on the balance sheet, and we start asking ourselves whether we've consumed or received the benefit from some of those costs. So in activity L, we're going to look at the rent. If you remember, we paid $48,000 for the entire year, which is equivalent to $4,000 a month. We stored the entire $48,000 on the balance sheet. In activity L, what we're going to do is remove $4,000 from the balance sheet and reflect it as an expense. So how do we do that? We record a negative $4,000 in the prepaid expense column in the asset section, and then in the expense section, we record a similar $4,000 in expense. What you can see is that good old tan arrow transferring that $4,000 over to retained earnings and reducing it by 4. That process again happens at the end of the month in the closing process after we've drawn up the income statement. So this journal entry is an accrual journal entry. You can see there is no cash involved with this entry. There was cash involved when we originally created the prepaid expense. But now what we're doing is we're assigning that expense to the appropriate time period. We're matching that cost to the right time period. And so we are consuming some of the prepaid expense that's sitting on our balance sheet. This is called a reversing entry. So we saw prepaid expenses climbing in entries B and D. And now in entry L, the prepaid expense is starting to reverse. So now we're going to continue to look at the assets that are sitting on our balance sheet and ask ourselves, have we used or consumed any of them? And we look at the machinery of $100,000 that we purchased in activity C, and we conclude that we have used up $2,000 of the value of that machinery. So we need to reduce the value of the net fixed assets on our books by $2,000. And then similarly, we're going to reflect that $2,000 as a cost of doing business by showing it as an expense on the income statement. Just like the other expenses, as a result of the closing process, that expense will be removed out of the expense column, transferred over to the retained earnings, and will reduce the retained earnings balance sheet account. So let's go back and look at the asset and what's happening with it. It originally was recorded at 100, and now we're expensing away some of the value. We're reversing the 100, so liquidating it, decreasing it by $2,000. For those of you that have studied a little more accounting, you know that when you go to do journal entries, we're going to break apart that fixed asset column into two separate columns. One will have the historical cost of the machine, and the second column will have what's called accumulated depreciation. But for today's example, we're going to keep it simple, and both increases and decreases in fixed assets are all recorded in a single column. So we're continuing as part of our process to finish our books at the end of the month to make various adjusting entries. We've done two, one for rent and one for depreciation. We're now going to look at insurance. If we go back to activity D, you'll see we spent $24,000 buying a 2-year insurance contract. In other words, we're paying for insurance at the pace of $1,000 a month. So it's the end of the month. So what we're going to do now is consume or expense away some of the prepaid expense we have stored in the asset section of the balance sheet. So you will see in this journal entry, prepaid assets, prepaid expenses, which is an asset, declining by $1,000. At the same time, we are recording an expense of $1,000. We go and open our mail, and for activity number 11, what we find in the mail is that we've received a check of $45,000 from one of our customers. So this check is going to reduce the outstanding balance owed by the customer. So accounts receivable will drop by $45,000 and cash will increase by $45,000. This is another type of accrual journal entry. In this one, what we're doing is we're reversing, eliminating, liquidating an account receivable that was created when we sold some merchandise to customers who did not pay us cash at that point in time. We now record our last business transaction for the month. We decide to pay our vendors $80,000 of the amount that we owe them. So we see cash, an asset, goes down by $80,000, and accounts payable, a liability, goes down by $80,000. What we can see by doing this in the case of the account payable is that we are reversing or liquidating some of the amount that was owed. So we originally incurred $190,000 in expense. We've now paid off $80,000 of it. Now we've recorded. Before diving into preparing some of the statements that are required for this homework problem, I want to step back and talk about 3 of the accrual journal entry types that we have seen in this particular problem. First, we're going to look at accrual activities that arise out of revenue. We do not have an accrual activity when we look at the row 1 journal entry being depicted. That's when cash and the earning of revenue occur at the same point in time when you go and buy a sandwich downstairs at your cafeteria. At that point in time, both cash and revenues change. We, however, have to create some accrual journal entries when there are timing differences between when cash is paid and received or when costs or revenue are recognized. So in the second row, you will see an accrual activity, the one activity that was not covered in this homework problem. We'll see it in another problem. In this activity, in the row 2 activity, the cash is received first, and then the performance, the delivery of the goods and services occurs in a subsequent period. This would be the example when you buy a magazine subscription. So when we're going to try to record that first transaction when we receive cash, cash will go up, as will a liability that we'll call deferred revenue or unearned revenue. In the next time period when we actually deliver the goods or services, we will then reverse that first journal entry, reducing the amount of deferred revenue. And so at that point in time, the liability decreases and revenue is recognized. And when revenue is recognized, ultimately, retained earnings goes up. So now let's move to the first of the 3 accrual types of journal entries that we saw in this particular homework problem. This occurs when we receive cash after having earned revenue. That is, we sell some goods and services to a customer who agrees to pay later. So in the red box, you can see revenues are recorded and retained earnings goes up. At the same time, an asset called an account receivable goes up. That account receivable has been originated. It's a holding account sitting on our balance sheet, and it will be liquidated, reversed, eliminated once the customer pays. So what we can see in this row 3 example is in the third time period, the customer pays us cash, cash goes up, accounts receivable go down. If we add together the journal entry that occurred in period 2, where the account receivable is created, and in period 3, where the account receivable is eliminated, and added them together, the ultimate effect on our balance sheet is that revenues were recognized and cash went up. And that is the same entry you saw in the top row under period 2. So accrual journal entry is simply trying to take into account the fact that there is a timing difference between a cash movement and the economic recognition of revenues and expenses. So now let's look at the second group of accrual journal entries, those associated with expenses. In the top row, we actually have a traditional cash entry that does not involve accrual accounting. So let's imagine that we go to the corner office supply store and we buy some pencils for our business. Those pencils are recorded as an expense, and we spent cash buying those pencils. So the expense will lower our retained earnings after it has been reflected on the income statement. Now, let's introduce 2 different timing differences that will create accrual accounting. In the first timing difference, you pay the cash in advance of recognizing the expenses. We saw that in great detail in this homework example where we paid for rent and insurance in advance. Cash went down, and we recorded an asset called prepaid expense in period 1. At the end of the month, then, we went back and looked at, for this month's activity, just this current activity, how much of that prepaid asset did we end up actually spending, consuming? And so then we would record a journal entry which would reduce the amount of the prepaid expense on our books and would record an expense, rent expense, insurance expense, in our income statement. And from that income statement, that expense will be transferred into retained earnings, lowering equity. So that is our third type of accrual journal activity. And what you can see in this case, just like we saw in the prior 2 ones, is the first period creates a balance sheet account, in this case prepaid expenses. And in the second period and subsequent periods, there will be a set of journal entries that reduces, reverses, eliminates that holding account that we created on our balance sheet. So what will ultimately be left on our books is a journal entry that looks just like the one in the top row, where cash drops and expenses have been recorded, dropping retained earnings. So let's now go to the last row, to our fourth type of accrual entry. In this particular scenario, it's what happens when cash is paid after we recognize an expense. So we could have incurred a cost that we owe to a vendor, but actually in advance of paying that vendor, we have either gone ahead and sold the item that we purchased, and hence we have a cost of goods sold, or we actually could have stored that cost on the balance sheet as an asset. So what we can see here is the original entry is we record an account payable, meaning we owe a vendor, and either, honestly, we could have recorded an asset or an expense. And then in the second entry, we pay off that vendor. So an account payable is created, and then when we pay the vendor, the account payable is reduced or eliminated. So I've now covered the 4 different types of accrual entries, and now moving on to the next requirement in this problem, which is to create an income statement. How we're going to do that is we're going to look at the financial statement template and the retained earnings column within it. And I have highlighted there in red the portion of the changes in the retained earnings that are associated with the income statement. We will start our income statement by recording Montero Company, the name of the statement we're writing, the income statement. It could also be called the statement of operations, and then the time period. And remember, when we're doing an income statement, it is over a period of time. So what we're doing here is to say for the month ended July 31st, 20x2. We'll now transfer the top line that needs to be recorded from the template onto the statement, which is sales of $205,000, and that's denoted in the template with the positive 205 in the revenue column. The next part we're going to add to the income statement is the cost of goods sold. So that was activity H of $155,000. We now have the option of offering a subtotal called gross profit, which is sales minus cost of goods sold. It is often displayed in a well-prepared multi-step income statement. After the gross profit, all of the various other operating expenses are depicted. In this case, we have rent, depreciation, and insurance expense, and they're all added together to give us total operating expenses of $7,000. If there had been income taxes in this example, that is the one category of expense. That's one category of expense that would not be included, and generally interest expense would also not be included. And now, as we have reported all of the revenues and all of the expenses that we've recorded in this homework problem already on the income statement, it's now time to bring the income statement to a close with the grand total of net income, which is $43,000, the $50,000 of gross profit minus the $7,000 in total operating expenses.